Capital growth is one of those investing terms that sounds complicated, but the idea is very simple. Capital growth just means something you own becomes worth more over time. That's it. If you buy something today and later you could sell it for a higher price, the difference is capital growth. Here's an everyday example. Say you buy a bike for $400. A few years later, it's in demand and someone is happy to pay $600 for it. You paid $400, you sell for $600, and the extra $200 is capital growth. In investing, the thing you own is usually a house or a small piece of a company. Let's use a house because it's easy to picture. Imagine you buy a home for $500,000. Years go by, the area becomes more popular, and similar homes are now selling for $650,000. You paid $500,000, it's now worth $650,000. That $150,000 difference is your capital growth. One important thing to understand is that capital growth is not money you get every week or every month. It doesn't show up in your bank account while you're just holding the property. It's more like the value quietly increasing in the background. Most people really feel capital growth when they sell. Capital growth matters because it's one of the main ways people build wealth over time. Big changes in your financial position usually come from things going up in value over many years, not from small bits of money here and there. Now let's talk about something related but different: cash flow. Cash flow is the money you have left over after your investment pays its bills. With property, cash flow usually comes from rent. Here's a simple rental example. Say the rent coming in is $2,400 a month. Your costs add up to $2,300. That leaves you with $100 left over. That $100 is positive cash flow. If your costs were higher than the rent, you would be topping it up from your own pocket, which is negative cash flow. So here's the key difference. Capital growth is about value going up, and you usually get it later. Cash flow is about money coming in regularly, and you feel it now. A helpful way to remember it is this: capital growth is the house becoming more valuable, and cash flow is the rent left over after the bills. Both matter, but for different reasons. Capital growth is what can create the big result over time. A property that rises by hundreds of thousands of dollars can change your options in life. Cash flow matters because it helps you keep the investment. Even a great property can be stressful if it costs you too much each month. Cash flow helps cover bills, handle repairs, and makes the whole thing easier to live with while you wait for growth. Now let's talk about why location matters so much for capital growth. House prices mainly move because of one thing: how many people want to live there compared to how many homes are available. In areas where lots of people want to buy, competitors compete. When competitors compete, prices tend to rise. These are places with jobs, transport, schools, shops, and a lifestyle people want. If there aren't many new homes being added, that competition can push prices up over time. Now imagine the opposite. Fewer people want to live there, or there are lots of homes for sale and not many buyers. Sellers compete instead. Prices can stay flat or even fall. This can happen when jobs disappear, people move away, or too many homes are built at once. So the link is simple. More demand usually means higher prices and stronger capital growth. Less demand usually means weaker growth. That's why location matters so much. Capital growth, cash flow, and demand all connect, and once you see that, investing becomes much easier to understand.